Welcome to Financial Strategies with Andrew Agemy in Connecticut and Daniel Agemy in Colorado.
Daniel, was kind of funny, I thought, when we were talking to somebody that had come to one of our webinars, and this guy was in another state, and he was so concerned. He said, "Oh, we sent him some educational books, and he really loved what we did for him, and then all of a sudden he kind of ghosted us, and we were like, what's going on?" He was a very conservative guy, wanted to be able to um, uh, preserve his assets, and then we finally got a email from him saying, well, I put my money in 2 year 5% CDs. And the question that I had for him that he never answered was, well, but they're 2 year CDs. So what happens in year three? I'm Andrew Agemy.
And I'm Daniel Agemy, and you're listening to Financial Strategies. Today, we're talking about banks, CDs, and inflation. And tell us more about what your concern is. That because banks are safe, right? There's no banks failing around us. Banks are good. Rates are only going to go up, so you don't want to lock your money up for too long, right?
Oh, you're so funny. That reminds me of the show that we did, buy high and sell for higher, right? Oh, just, the market's just going to go up. So why not just buy some more of it, right? And that's the same concept happening with CDs now, right? Oh, I don't want to buy a CD now because rates are going to go up, or, they're always going to be this way. The thing I love about our country, this, as far as I'm concerned, is, we're still, America is still the best country on this earth. And one of the things that makes our country so great, and that I like about our country, is our optimism. But one of the things that hurts us so much as well is our optimism. you know and so here's one of those things, right? Like, the market's always going to go up. Well, no, the market doesn't always go up. You have to prepare, right? Hope for the best, plan for the worst. And to now, we've got this scenario where people are saying, run into the banks because they can get a 5% 1 year or 2 year CD, and they're running to the banks, which, it's phenomenal. We haven't seen rates like this in 15 years. But what's the other end of it? Rates are not going to be forever. They're not going to, be for the long term. Retrospectively, we could have gone back and talked. In 1982, you could have got a 30-year Treasury bond for probably 15%. That would have been a phenomenal investment, right?
Yeah.
A 30-year 15%. Somebody would have made a lot of money, and I'm sure some people did do that. Not,
Yeah.
it was the exception rather than the rule.
Yeah.
But how many people back then would have said in 1982, when they could get 15% Treasury, said, "Oh, I'm going to wait because rates are going to go up," and then by the time they get around to doing it, right, it was
Probably a lot of
12%.
people. Probably a lot of people, right? And who they would have been like, I'm not going to buy a 30-year. I'm not going to buy a 30-year. That sounds insane. Like, rates would just keep going up, keep going up. And like, if you had done this, because it's not always the peak. So say you did it at 15%, not the 18 you're talking about. You did it at 15, and then the value of your bonds went down because now they're issuing 18, and you're like, oh, I made a bad decision. But if you bought that 30-year, that outperformed the stock market by a lot,
A
almost
lot.
double. Yeah,
That's right. That's right. With no
over that period
risk.
of time. Yeah,
Right. Right. But, people aren't enamored with the stock market because of what it did during that period of time. But that's because they missed out on the better deal, which was a 30-year Treasury bond at 15%.
yeah,
And that's what I'm afraid is going to happen to people today. In this story of this guy with the 5% 2 year bond, well, or a 2 year CD, why didn't he get a 5 year? Because he could have got a 5 year at 5%. But, you're not going to get a 20-year Treasury at 5% right now, right, Daniel? What are the long-term Treasuries doing right now?
well, if like a 10 to 20 years, probably somewhere around 3.8. If you are a little worried about going that long and you want to be in that kind of mid 7 to 10 year, 3.5%.
Yeah, which is crazy, right? So in and
So
so in
let's explain. Let's explain real quick here
Please.
how bonds work. It's like a seesaw. When rates go up, the value of the bond goes down.
Right.
And when rates go down, the value of the bond goes up. So if you
Mhm.
have a $10,000 bond, you buy it at 5%. Let's say you bought these, let's say you bought these 7 to 10 years that we're talking about, because we did buy some of these for people when they were around, that 4.85% range. And now you can't get that. So the coupon is still the same.
Right.
You're still earning the same amount of interest, but the value of the bond, because you can't buy those 5%ers anymore, has gone up. So now your 10,000 is worth, it's worth closer to $11,000
Yeah.
compared to um compared to if rates had gone to 6, it would have come down in value.
Right.
So
Right.
always think of the reverse. The value goes down as rates go up, and the value goes up as rates come down. So those 18% treasuries you were talking about, you bought them at $1,000. Well, towards the end of these things, as they was getting close to the end of these things' lives, 5 years away, they were probably trading at 150, 170, maybe even over $2,000 a
Right.
bond. I'm
Right.
not, I don't have the math right here in front of me, but
Right.
it's all of this is not guessing. It's certain. It's mathematically certain. Like it's
Right.
all mathematically certain. You can calculate all these things. And so
Ah,
that's why if you're thinking rates in 2 years are going to be a lot higher, you're making a pretty big bet, um, because you're going to have a problem. You're going to have a reinvestment risk problem.
right. Well, Daniel, it's just what people do. Like I said, when we did that show, buy high, sell higher. You know, could that happen? It could happen, but it's probably
Yeah.
not going to happen. Right. And that's what people have to be aware of. And that's why you're listening to Financial Strategies with Andrew and Daniel Agemy, because people don't know what people don't know. How are you going to know unless somebody tells you? Well, you're listening to the show that will tell you things that you're not going to hear from Wall Street. So today's topic is banks, CDs, and inflation. And Daniel and I have a great show for you today. We're glad that you're here, and we have a paper that we'd like to give you that will explain more about things that are going on. This is called Passive Income for Retirement. So just call it and ask for passive income, 800-725-7616 for your free copy. It's a 3-page report on passive income for your retirement, how you can protect yourself against all the different, I shouldn't say all the different, but against different scenarios that would plague you by going into a 2-year CD at 5%. So, this is just crazy what's going to happen after that period of time, right? When the CD comes due, what are rates going to be then? Daniel, what's your
Right.
view? What's your view?
Well, okay, there's two things. If you're buying a 2 year with some of your money so you can have an investment opportunity, that's completely different than taking all of your retirement money and putting it in 2 year. That's
Right.
that's pretty foolish in my mind, because you're going to have a big reinvestment problem, and you'll probably do the opposite of what these banks did, where these banks, um, they invested all their money at 1%, and now it's 5%, right?
Right. Right.
So people wanted their money back. The banks had losses. They couldn't get them. That's the whole Silicon Valley bank problem. We could go more into that later. But you can run into that same problem. So if you put all your money into a 5 at 2, right? 5% at 2 years, and then we're back down to 1% when those come due. What do? Stocks will probably be up at that point,
Yep.
because go, 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 right? If you can't,
Right.
so you got this problem. So ideally, you get as long as you could at 5%. Um, but then if it's all your money, you have this new problem where you have credit risk. And you say, well, CDs are guaranteed by the government. Well, up to 250, right? So there's a lot of different ways we could go with this. Um, but but all your money in one thing is never a great idea, right? Especially if it's
Right.
your retirement money.
Right.
So you buy two CDs for 5% for 2 years. Why not divide that up? Why not four? Buy one for 1 year, 2 year, 3 year, 4 year, right? There's some different strategies you could do to help you out.
Yeah.
And if you're buying them at the same bank, you're still got a big problem because only 250 of that is backed up.
Wow, Daniel, I think we should, help people understand how they don't have to run around to different banks. How what's available to them, at least what we do for our clients, right? Because in the old days, Daniel, you don't know this. You probably know it because you're a smart guy and you've heard it, but you don't know from example, which was people would get back when double digit in CD rates in the 80s and the 90s, people would get this, and then they'd run around to the different banks and say, what are you paying when their CDs came due? And so then they would move their money from one bank to another bank, and that was their retirement job kind of thing, because that's how they made their interest, right? And today that is just really hard to do. And then you get these banks that they buy new assets, right? Oh, it's 5% for 2 years, but it has to be new money to the bank. So you got to bring it from elsewhere. What about the money that's at the bank? And now you have to do all this finagling, and it's ludicrous, right? There's a much simpler way to getting that done. And so we'll
Yeah.
want to make sure we talk about that. Okay. So anyway, I want to let you know it's time to take a break. You're listening to Financial Strategies with Andrew and Daniel Agemy. Today's topic is banks, CDs, and inflation. Well, how do all those go together? Well, we're going to explain to you. Stay tuned, okay? We're going to take a break, but before we do, we want to give you this book today, which is The Most Important Thing by Howard Marks. This is a book that will give you ideas how to be able to preserve your money and how to be able to help you be protected against some of the things going on out there. Which reminds me, Daniel, you mentioned that that the market will probably be up when their CDs come due. People, want to let you know that one of the reasons why the market is down is because rates are up, and that's what they're trying to do. But when rates go down again, that will make the stock market go up again, and so that's the general idea. But Howard Marks in his book, The Most Important Thing, will give you some perspective of how you can invest and how your philosophies and attitudes should be in regard to making sure that you don't run out of money during your lifetime. So call for it by name, call for the book, ask for it. The Most Important Thing, 800-725-7616, 800-725-7616 for your free copy of The Most Important Thing. Call now.
This is Financial Strategies with Andrew and Daniel Agemy.
Yesterday, I was talking to Jim and Sally, some clients of ours that had money in the bank, and their CD rates were down to like 1-2%, and they decided to pull that money out of there and give it to us to be able to invest it for them and be able to make it safer than it was in the banking, the higher rate of return. So they're very happy. By the time I got off the phone call yesterday with them, they were just so happy about stuff. But the thing that I'm bringing up is it's really interesting what happened with these two people, Jim and Sally here. With I was talking to them. They had, I don't know, a few $100,000. We were talking about investing it in different ways. I think it was about $500,000, and they wanted two $100,000 CD-like annuities. And Jim said, Andrew, my problem has always been is that, like, I go into these CDs, and then it comes due and the rates are lower, and it gives me, then I have this problem, and I don't want that problem. What can I do? So I said, Jim, you know what? I can get you these CD-like annuities that will be 10 years at 5% for 10 years. He said, sign me up. So we got two $100,000 10-year CD-like annuities paying 5% for 10 years, right? No, wrong. Because by the time it actually got issued, he's getting 5.25% every year for the next 10 years. So this guy invested $100,000, right? And he's going to make over $50,000 over the next 10 years in interest from these CDs, CD like annuities. I'm Andrew Agemy.
And I'm Daniel Agemy. and you're listening to Financial Strategies. Today we're talking about bank CDs and inflation. And that's a great
Good
story. That's a
story,
great
right?
deal. You missed one part though.
Oh,
You
what's
didn't talk
that?
about the compounding nature of that
Oh, yeah, you're right.
or the
Well, I said
tax
over
deferral.
50. Right, right,
So if you compare that to a CD, most people we're dealing with are somewhere in the 25% bracket.
right.
So 25% of that money, that $5,000 a year they're earning on those CDs, 25% would be come out of your pocket and go to the government. But
Right,
in that annuity, CD like annuity, you don't
right.
have to pay taxes on the money until you take it out. So it can compound even faster.
That's right. That's right. It's a beautiful thing. But but that's one of the things that he was concerned about. What we started off the show with, right? That guy that took the 5 year or the 2 year CD at 5%. And then what does he do at when it comes due? And that's what this client, Jimmy, said, I have always done that in the past, and I don't want to do that anymore. And so we were able to come up with this 10-year one, which is very phenomenal, right? Because where are you going to get 10 years for 5%? It's essentially unheard of. I can get that for you, but
Yeah.
that's another thing, right?
Not the
But
banks, that's for sure.
but not the banks, and not mature, not treasuries like we talked about last time. But the point is, he didn't want to go through that again, and he's very concerned. He's got cancer. He's got Parkinson's. He was in Vietnam, so he's got Agent Orange, and he doesn't see himself living another 10 years, but he does sees his wife living that long, and he wants to make sure that she's taken care of. And that's a huge thing that a lot of times, I see guys, usually it's the guy that's doing the investment stuff. And I see guys that don't take care of their wives, and I see guys that do take care of their wives.
Hmm.
And that is the thing that's close to my heart is, making sure that widows and orphans are taken care of, like James 127 says. And, one of the things that I'm a proponent of, and I was just going to, this doesn't have anything to do with banks and CDs and inflation, but the fact that, you know, uh, what's going to happen to the spouse who doesn't know the finances when the spouse with the finances and understands it passes away?
Hmm.
Well, wouldn't it be better to get involved with somebody that can help take care of that spouse ahead of time? And that's what Jimmy was so happy about. He says, Andrew, I know you're going to take care of my wife. I know I'm not going to have to worry about this. I provided the money. You're making it grow, and she's going to be okay. I said, that's right, Jimmy. We're going to take care of her. So that's a huge thing.
Yeah, and we see that problem that Jimmy was talking about a lot. And banks, a lot of these banks are offering short term, 2 years, 1 year, 6 months, and that's what people are very comfortable with because they think like rates will just keep going up. Um, and then what will happen is the people will forget about it. They'll think they're earning 5%, and then the bank will roll it over. They'll do a sneaky thing. They'll roll it over at like 1% or something like that, and the person will just sit it there. So
Right.
as you're talking about spouses taking care of spouses, the spouse thinks it's the one passes away, the other one thinks it's good. They think it's earning because my husband took care of me, whatever, and it's rolled over at one of these lower rates. We've seen that how many times? Um, Except we've seen it at like 0.01% that it's rolled
Right.
over to.
Right.
And you know, we'll get into inflation, we'll get into the solvency of banks. We'll get into some of these kinds of things, but like then you have this problem where inflation, inflate we you and I care about lifestyle inflation, right? We
Right.
don't
Right.
care about CPI.
Right.
Retirees care about
Right.
lifestyle inflation. Um, CPI doesn't matter. It doesn't matter what Janet Yellen tells you. It doesn't matter what the government tells you. What matters is your lifestyle inflation. Now, if
Right.
you don't see any inflation, then you're fine earning, 2, 3%,
Yeah.
5%,
Yeah.
right? But if your inflation, if the things that you care about, your plane tickets to travel the world, helping your grandkid go to school, get the education they need, buying your beach house, if you're doing these kinds of things, your inflation is a lot higher than 2, 3, whatever these things roll
Right.
over at.
Right, right, and that brings up a great point, Daniel. Because yesterday I was talking to a guy who said that he goes to the store and he gets these three items, two pies, he told me, and I forget what the third item was, right? And normally he gets change back from his $5 bill, right? But the guy says, that's $8. And he said, what are you talking about? Well, he says these two pies are a dollar each. The guy said, no, they're $1.67 each. And he says, that's not the 6%, 8% inflation that the CPI says. That's 67% inflation, right? And then another guy, well, actually it was Jimmy was telling me, because he's concerned about widows. He's telling me about a widow that likes these $3 pies that are now $6 pies. It used to be a treat for her to be able to get the $3 pies, and now she can't buy them anymore because she can't afford them. That's 100% inflation. So that's lifestyle inflation. And boy, I'm just getting so excited here, Daniel, that we're just going along. Hey, you're listening to if you just joined us, Financial Strategies. Thank you, Daniel Agemy. We're having a great time today. I guess I'm pumped up on that coffee. But today's topic is banks, CDs, and inflation. And we're talking about all these things because people are becoming enamored again with banks and what CD rates are and stuff. And there is a place for them, but it's not the end all and be all. You can't focus solely on CDs and the rates that they're paying. So we have a paper that we'd like to help you be able to understand this letter. It's called Passive Income for Retirement. That's what CDs create. They create a passive income. But how long are those rates going to go on for? We don't think they're going to go on for a long time. And that's what we're talking about. Long time income for inflation, for retirement, right? Passive income for retirement. You have this paper for free by calling us at 800-725-7616. It's called Passive Income for Retirement. Ask for it by name, Passive Income, 800-725-7616. You're listening to Financial Strategies with Andrew Daniel Agemy, because people don't know what people don't know. Stay tuned and you'll know something that you didn't know before. Daniel, this we're the title of today's show, Banks, CDs, Inflation. We're talking about CDs a lot so far, right? And we need to talk about, well, what's this thing with banks? We're getting a lot of people talking about, calling up, say, hey, Andrew, is my money safe? What, this bank thing going on? What's the deal with my money? And I am like elated to tell them that at least most of our clients, how their money is they don't have anything to worry about, but most of their money is not in banks. So what's the deal?
These bank failures have been pretty interesting. One is we did a show. Unfortunately, it didn't come out until after the bank collapses. But we were talking about banks are not as safe as they seem. And we recorded it before all this chaos.
Right.
We're talking about central bank digital currencies, and we said, if you have more than $250,000 in the bank, you need to talk to us. Well, those Silicon Valley people didn't, and they needed Janet Yellen to bail them out. But this is exactly what we were talking about. Unfortunately, the show came out after because we were recording them because we were doing some traveling and whatnot. But
right.
but what we need to watch out for here is the banks actually these bank failures actually are following a pattern. And this pattern is we've been talking to clients, saying, you've got this money in the bank. We can get you 5% in US treasuries. It's safer than the banks, and you have upside potential because you're going to get 5% no matter what. But when rates come down, when there's a panic in the market and rates come down, your value of your treasuries will go up. And so people were like, banks are good. Banks are good. And some people took our advice, went into US treasuries. Well, these banks failed. And do you know what all the people with these millions and millions and hundreds of millions of dollars in the bank did? They put it into treasuries. Do you know what happened to treasuries?
They went
up in value. The yields came down. The yields
came down. The value went up. Okay.
So now they're not paying 5%, right? Now they're paying 4.5% or something. But actually, we were getting like 5.3 before that happened, 5.4. Wow. But so they came down to like 4.5. But the values, the money you invested went up. So those clients who listened, actually their money went up because everybody else caught in. But what the bank failures have done is it got people saying, wait, it made awareness. Wait, I'm earning nothing in my bank account, and I can get 4% in a money market. I can get 4.5% in a treasury. I can get 5% in a CD. And so now people, we were talking about this for months and months and months, but it took failures in banks for people to say, hey, look at what's going on. I need to start making my money work for me. So hopefully you were one of those people that took advantage of that before it went down. But we'll get more into all of this after our break.
All right, good. Well, boy, this is just exciting today, huh, Daniel? I mean, these are usually exciting shows, but today, especially, we like to give you this book. You listen to Financial Strategies with Andrew and Daniel Agemy. Today's topic is banks, CDs, and inflation. And the most important thing by Howard Marks is a book that will be able to help you to understand what the most important thing is about your investing. And we'd love to put this in your hand. It's an easy read book, and you can get through it in a few hours if you read it cover to cover. We'd love to put this in your hand for free to the next 5 callers at 800 725 7616. 800 725 7616. Call now for your free copy. We'll be right back after this.
You're locked on to Financial Strategies with Andrew and Daniel Agemy.
So, I was doing a review for some clients. I'm going to call them Patty and Mark. We never use their real names, right, to protect the innocent. And um, Patty and Mark came in for a review, and they were really concerned. This was a couple weeks ago, just after the Silicon Valley Bank debacle, and they were, Andrew, what's going on with our money? Is our money safe? What's the deal with this? And I'm sure we have a lot of clients, and I know I've heard a lot of clients asking this question. And I had a great conversation with Patty and Mark because as we went through and reviewed everything, I was able to say your money, in my opinion, is safer than it would be in the banks right now. Your money, they had a little bit of money in the bank that they decided to pull out of the bank and put it in something safer than where it was. But I said to them, I said, Patty and Mark, the good news is that we prepared you for this years ago. We didn't know this exact thing was going to happen. We had an idea that something like this could happen, but we set you up in such a way that you would be in good situation today because we want to be able to say to you, you're set. You don't have to stress. Don't worry about your retirement. Your money is okay. And we're working diligently to do that. And so they made some changes to make it even more palatable to them and even more stressless to them. But it was so good to be able to say stress free, so that you're in a stress free situation. I'm Andrew Agemy.
And I'm Daniel Agemy, and you're listening to Financial Strategies. Today we're talking about banks, CDs, and inflation. And AAA, that's somebody might say to you, what could be safer than the banks? The banks are backed by the government. And you look at Silicon Valley Bank, right? The government
Yeah.
made sure that they were whole.
Well, let me. I know you're going down a track, but I just want to say something here, Daniel, with this. Okay. So, talking about that, the banks are backed by FDIC, and FDIC in the past 32 years, 33 years, has almost gone bankrupt twice. And if we have another 2008, they're probably going to go bankrupt, in my opinion. And if they go bankrupt, where are they going to go? They're going to go to the government to back them up and print more money and that kind of thing. But for my money, I would rather depend upon being insured by the private sector who's in business to make money than the government sector who's in business to take money and spend money. And so, we really have to look at what's going on behind the scenes. So, anyway, with that, go ahead, Daniel.
We used to have a client, and he liked to listen to CNBC or whatever that financial news program is with the guy that likes to yell buy stocks, right? And funny thing, that guy that likes to yell buy stocks said you should buy Signature Bank and Silicon Valley Bank. Like this is on YouTube. You can go literally watch him say a few months ago, these banks are great. And both of those banks are no longer with us. They didn't go down a little bit. They're gone.
Yeah, right. Right.
But anyways,
good news, right? Boy,
this is how fragile the banking system is. Okay. We keep hearing, like, they've been preaching since 2008 how much stronger the banking system is. It doesn't have the leverage it used to have. It's not like Lehman Brothers, right? and preaching this, but this is how fragile the banking system is. These two banks that looked fine, that looked like they had great balance sheet, Silicon Valley in one day, right? Friday
Right.
morning to Friday afternoon. No, Thursday night to Friday morning. So typically when a bank fails, and banks fail in the US all the time,
Right.
all the time. The FDIC is just very good at taking them over, so most people don't even know what happens, but they fail all the time. Um, they usually go in on a Friday night, and then they have 2 days to fix it. And by Monday, it's open, and nobody knows anything happened. The bank run happened so fast at Silicon Valley Bank. They didn't have time to wait to Friday night to take it over because the money was leaving. And they had to come in on Friday afternoon to take the bank over. They couldn't wait because that's how fast money left. So you have these banks that looked perfectly solvent, that looked perfectly good, that this guy who used to be our client would have said, these are great banks, right? The banking system's fantastic. It's nothing like Lehman. But that's how fast it can change because of fractional reserve banking. Fractional reserve banking basically means if you take $100 into the bank, you put it in the bank account, the bank can they need to keep on the high side $6 of that, and then they can lend the rest out. Okay, so you think about that. They keep $6. They take the other $94. They lend it out. They do whatever. Now, what happens if somebody wants $100? They only have $6, right?
Right. Right.
Um, and that's bank's job, right? They lend short and they borrow long.
Mhm.
Um, So that's the opposite of people. You put your money in the bank, you give the bank the money for short term, and then they go give somebody a 30-year mortgage, or they go give somebody or they go buy 30-year treasury bonds, right? And so they need the liquidity, they need the short term liquidity to meet demands when you ask for your money that it's there. And so if they're lending in long term things like 30-year treasuries, which is what happened, 30-year long duration assets, which is what happened to Silicon Valley Bank. They invested something like, let's say, $120 billion. And that $120 billion, because we talked earlier about how the teeter totter works, right?
Yep.
When
Right.
rates go up, the bond value, even though it's a safe asset, it's backed up by the government,
Right.
the market value can come down. So if they have to liquidate it before the 30 years is up, they took a $20 billion loss. And we talked about they don't have the money because they only had to keep $6, right?
Right. Right.
So they don't have the money. So that's what ended up happening was they couldn't get the liquidity in time to to meet all the demand. And this
Oh
is
wow.
how fractional banking works. If
Yeah.
if like the movie Wonderful Life, it explains it perfectly, right? Everybody comes rushing in asking for their money,
Run on a
and
bank.
George
Yeah.
says, "I don't have the money. It's in George's
Your
house and
house.
it's in
Yeah.
Mary's house, right?"
Right. Right.
That's how it works. That's how it's designed. So people put a lot of faith and confidence in this banking system, but when you see how fragile it is, you start to say, "I need some more I need some more diversification. I need somebody that's watching out for me, for me and my money, not the stockholders of the bank or not the bank executives,
Yeah.
right?"
Yeah. Well, you're listening to Financial Strategies with Andrew and Daniel Agemy. Today's topic is banks, CDs, and inflation. And we're moving along today. We have a paper to go along with today's show that will help you to be able to understand other ways of putting your money and making money on your money, making interest on your money than CDs and then the banks. Now, we're not selling annuities, but this paper is called Annuities Income for Life. And so you can get annuities that can give you income, you can get annuities that give you interest, and this paper will explain annuities 101, you might say. So we'd love to put this in your hands so you can have another perspective, another idea of how things work. Because a lot of people will say, oh, annuities, I don't like annuities. Well, they usually don't know what they're talking about. And this will be able to give you an idea of what annuities are about. So ask for it by name, annuities, and call us at 800-725-7616. Get your free copy. Daniel, you're doing great here, man. This fractional what did you call it?
Fractional reserve banking.
Fractional reserve banking. It's
that's what
crazy.
the
So
banking system is. Yeah.
yeah. So what you're saying is, and equating it to It's a Wonderful Life, where everybody lined up, right, to get their money. That was a run on the bank, right?
Hmm.
And remember the taxi driver, hey George, I think there's a run on the bank, right? And that's what they're doing. They're actually literally running to the bank to get their money.
Yeah.
Well, with the fractional banking, um, right, that's not going to happen, right? They're not going to run physically to the bank. Am I correct? Did I understand that right?
No, no, the fractional banking is exactly what like it happens in the Wonderful Life, right? There's not the money. By fractional reserve banking,
Okay.
a
But
good amount is having 6%, right? 6%
right. So that's the
of the
fraction, a
liquidity.
fraction of the money.
Mm.
Okay, got it.
Hmm.
Okay. But goes going along with that was the fact, the electronic nature that happens to where money's leaving electronically,
Yeah. See, this is good.
not
You're backing me up because I get going fast sometimes and people lose track. Um, yeah, exactly. But so this is a funny story. So there was reporters literally going around to bank and looking for lines for bank runs, just like in the movie.
right,
But that
right,
doesn't happen anymore. Nobody's going, like, nobody's going. Maybe there's one or two people that are literally
right,
going into the branch and asking for their money. But like Silicon Valley, for example, had APIs, so you could move $100 million in seconds.
yeah.
So where a fractional bank might have worked, and like regulators
API.
never
Okay.
caught on to this.
Yeah.
Like, how did regulators not catch on to the fact that money moves instantly? Like, look at our economy. Money always, it's always happening. It's not like I have to drive to the bank, sit down with a nice teller, ask for my money. It's Silicon Valley. They push a button on their phone and they can move $10 million from Silicon Valley Bank to JP Morgan or to pay, right? So that's why it happens so fast. Usually they can wait till Friday night, make sure there's no panic. The FDIC comes in, takes it over nice and slow. And by Monday morning, you don't know any because the FDIC is running the bank. You don't even know anything happened. But it happens so fast because of these APIs and because social media, people say this is happening. So then Silicon Valley execs, they've got $25 million in the bank. Like, think about these numbers,
Right,
right? Most of the people listening to our show don't have $25 million,
right,
especially not $25 million just sitting in the bank.
right.
um, they're just pushing buttons and moving the money to other places or putting it into treasuries like we were talking about. And the bank didn't have enough money. There was not people building lines up to the bank to take their money. It was all done on their phones, for the most part, right?
Right. Right, right. Well, this is interesting because this API, what I
Hmm.
would relate that to is like online banking for us, right?
Yeah,
Where you can just go online and you can
right,
just do click, 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 and except
right.
our online banking to pay bills online, it might take a week for the check to
Yeah,
actually get to where it's going
yeah,
because it's not actually electronic. It's
right.
it's we're asking the bank to cut a check, but this is where it's actually electronic, and it's just like online
Yeah,
banking for the banks that will bet they can
yeah.
make it happen instantly. So
Or for
interesting,
corporations, right? For corporations that want
right?
to pay somebody $100 million
Right,
for
right,
supplies,
right,
and they just push a button and it goes through the API through their accounting software. It just moves
right,
it. You don't have to mail a check and wait for it to clear and all this kind of stuff.
right.
Exactly.
Yeah. You're listening to Financial Strategies. Andrew and Daniel Agemy. Today's topic is banks, CDs, and inflation. And we're trying to help people to know what they don't know and to make your retirement stress free. To do that, we've got a book to educate you. The Most Important Thing by Howard Marks, which will be able to help you to be able to understand how to make things more stress free in your life. You know, our goal here, we believe that an educated retiree is a happy and stress free retiree. So we want to educate you so you can be happy and stress free. That's what today's topic is about. That's what this book is about. Call now. First five callers at 800 725 7616 for your free copy. 800 725 7616, your free copy of The Most Important Thing. Call now. We'll be right back after this.
This is Financial Strategies with Andrew and Daniel Agemy.
AAA, one of the things I get asked about all the time is people will say, Daniel, rates are so low. They were 5% back in the 70s and 80s. They were 16, 18%. So why would you say rates are going to come down? And I'll ask people, well, do you know what the US government debt was in the 70s and 80s? How much money were they paying interest on? And they'll say no. And I'll say, you know, it was probably $30 billion, or I shouldn't say $30 billion. It was 30% of it was in the 30s of GDP, right? So if you think about
Very
yourself
low.
and you say your debt is 30% of your income, that doesn't sound so bad, right?
Right. Right.
Well, do you know what it is now? It's close to 130% of GDP. And then I'll say, do you know if rates went to 6%, what the interest payment would be? Well, it really depends. But almost half of the US government debt right now is 5 years or less. So all that will have to roll over in the next 5 years. So if we take half of that and put that at 6%, that'd be about $1 trillion a year of interest payments
Wow.
for half of the debt. I'm Daniel Agemy.
And I'm Andrew Agemy, and you're listening to Financial Strategies with Andrew and Daniel Agemy. Today's topic is banks, CDs, and inflation. Wow, Daniel, that is $1 trillion in interest. So they like um, can't make interest rates go up from that standpoint, right? Um, long term, it's bad enough as it is, but long term, that's egregious, and that won't work.
Right. Well, they're already talking about running a $2 trillion a year deficit without that factored in. And that's where we get into inflation, right? Because the government could do that. They could
Right,
absolutely do that. They got a money printer. But do
right,
you know how it would ruin people's lives? Most corporations would go bankrupt. Most individuals would go bankrupt. Um, because there's too much debt, right? There's too much debt in the world for rates to stay at a high level for very long. And like
right,
I said, they didn't structure the US hasn't structured their debt where they could do that. Like Trump wanted to issue 100-year bonds at 0%, right? They didn't do anything like that. Like I said, almost half the US's debt is 5 years or less, and so it's all going to have to be rolled over.
right.
And when it rolls over, if we're at 5-6%, the coupons on those things are going to be 5-6%. That's near $1 trillion in interest.
Mhm.
And there's still the other half of the debt that they're paying on at whatever rates. Those are all various rates.
Right. Wow. Crazy. That's crazy. So the inflation so let's talk about how inflation and debasement works, right? So like you we were talking ahead, previous, in preparation for this, and we are talking about the value of an item, of a car or a house or something, is not really increasing, even though the price is increasing. The value is not increasing, right? So um, you know inflation has this effect upon stuff, right? Upon our cars, our goods, our houses, and inflation is the idea of more money chasing fewer goods. But then what that does is it makes the price go up, but it's not really of any more value. So, a house that was worth $300,000 a couple years ago is worth $500,000 today, but it's not really, more valuable. It's just keeping up with the whole thing, right?
Right. Right. So, um, this works a lot of different ways. So some people will say they'll just talk about inflation, and you and I don't care. We talked about this at the beginning. We don't care about CPI. It doesn't matter. It's pretty much made up. They can change. They can take stuff out to make it look like that 2% target.
Yeah,
And we're not trying to say government's, but we're not trying to do it. It doesn't matter. What really matters is like you were talking about those pies, right?
right,
Or a vehicle, or a house,
right,
or long-term care expenses or medical expenses, because a lot of people we're working with need their money to protect them for these things. Then
Right.
um, we look at how much it costs to fix financial problems. So back in 2008, in the big financial crisis, they spent a lot of money to fix the system. $800 billion was like a lot of money back then. That's
Right.
nothing now. Okay,
Yeah.
we'd be like thrilled to death if it only cost 800 billion. So the government, just for these banks that had problems, have already put together facilities over $800 billion. That's how the
Wow.
value of money has decreased so much over this time. So if we look at the fragility of banks, we look at the fragility of markets, and we say these things are too big to fail. That means the government's going to continue to take care of them. We are going to continue to see inflation. Now, the government's on one hand fighting inflation by tightening the monetary system, right? Raising rates. They're trying to get people to stop spending money so that inflation comes down. But that's CPI inflation. Asset inflation is something else. Asset inflation has been happening, or debasement of money. If you look at the S&P 500, it looks like it's done really well over the last, you know, 15 years or so.
Right.
If you compare that to the federal bank's balance sheet, it basically hasn't earned anything. It's flat. It's flat when you look at the dollar. So basically what it's done is it's kept people's purchasing power. So if you
Right.
haven't earned that kind of money, you've been losing money. Your dollar's gone. It hasn't gone as far. The same dollar is buying you less and less every year. And that's what we're talking about, not just whatever Janet Yellen comes out and says inflation is, or whatever Fed Powell comes out and says inflation is, right? We're talking about lifestyle inflation, the things you need now, the things you want now, and the things that you will need in the future, like long-term care, like housing, right?
Yeah.
Like medical expenses, these kinds of things if you're getting older, right?
Yeah. Yeah. And oh, Daniel, my mind's just going in a lot of different directions. What I want to say, but let's start. Let's do this. You're listening to Financial Strategies with Andrew and Daniel Agemy, because people don't know what people don't know, and when you're done with when you listen to us, you're going to know something. You're going to learn something, because that's what we're all about: is helping and educating people on how to be stress free in their retirement. Today's topic is banks, CDs, and inflation. And we have a paper we'd like to give you go along with this, which is annuities, income for life. And annuities, this will explain to you and teach you about how annuities work and how you can use them to your benefit. There's obviously a reason for that. And I can hear the skeptic out there saying, oh, why would I want to do that? Well, that's why you need this paper. We're not trying to sell annuities. We're trying to educate you so that you can understand if the annuity you have is any good, or if it's of any value to you. Earlier in the show, I talked about a guy that got a CD like annuity that's paying 5.25% for 10 years. So maybe that's good, maybe that's not. It all depends upon your situation, but you can educate yourself and help yourself to be stress free with your education. And so call and ask for it by name, annuities, and it's 800-725-7616. Call now. Daniel, we just have a few minutes left in our show today, right? And banks, CDs, and inflation. We're talking about what's going on with inflation. Banks, even at the 5% level, what people are getting CDs, they're not going to stay up with inflation and the real world inflation, the living expenses inflation, as we talked about. They're not going to be able to stay up with. But how to stay up in inflation encompasses a lot of different facets. Diversification is one of those facets, right? Let's talk
Right,
about that a little bit.
right. So we talked about bank CDs and some of the things people need to watch out for those, right? So like
Mm-hmm.
diversification in this. Um, how are you going to protect if you're putting all your money in CDs, or a majority of that? Are you doing that because you think in a year you're going to get markets are going to be down and you're going to be able to invest stronger, or rates will be higher? Or are you not thinking, you're just saying this is a good deal, I'm going to do this? Two, the credit risk. Do you have more than $250,000 in the bank
Right.
or in the CDs? This
Right.
is serious. This is,
Yes.
you were not messing around when we're talking about this. You have a bank that looks perfectly solvent one day and the next day it's gone, right?
Right.
Because of the financial leverage. This is something you have to work out. So you need diversification in that. And then what is going to protect you from inflation? So if we keep having crises, pandemic,
Yeah.
banking crisis, whatever is
Yeah.
next, right? These kinds of things, and we keep printing money. Janet Yellen's not calling it printing money. She's saying that taxpayers don't have to do it. Folks, it's a secret tax. It's called inflation. Whenever money's created out of nothing,
Yeah.
that debases the money that you have. That makes the money you have worth less. So she's saying it's not costing taxpayers, but if it's making your money buy less things, it's costing you money,
Right.
right? So if all your money is in fixed income, CDs, it's
Right.
all there and you have no inflation protection, what is going to happen to you if we keep having these things and we keep creating money? Your money won't buy you anything.
Right. That's exactly
Um,
right.
So that's what we're talking about diversification. You need things that will benefit from chaos in your
Yeah.
portfolios. Like we
Yeah.
talked about, those treasuries have gone up because of the chaos. These gold and gold related things, um, Bitcoin, some of these things, people get scared of these because they're volatile, but these things, you need a balance, and that's where the diversification comes in, because what looks risky may not be risky, and what looks safe may actually be the dangerous thing. And we could do a whole show right on that, but
Yeah. Yeah. And that's what I just wrote down, Daniel. I just wrote down. um, so here's the thing: what it boils down to in my idea, this world is is a specialized world.
Mm,
I mean, I remember 50 years ago when I broke my first bone, and I heard about um what are those doctors that fix bones? I forget the name. Anyway, the bone doctors, right?
the bone
I didn't know there was a bone doctor, right? Oh man, they talk about
orthopedic.
orthopedic. Thank you very much, Daniel. Orthopedic doctor, right? And I was like, wow, this is crazy. And specialization hit me because I never knew about it until that point. I was probably like 12 years old. And um, this world has been come to today. I'm hearing the other day, I heard somebody talk about a certain specialty, and I had, they named their doctor, and I was, what is that? I had no clue, never heard the name before. And that's constantly happening. And within the financial industry, the same thing happens. We're getting specialties, right? Look at the car industry. There's specialties. You got foreign car specialists. You've got electric car specialists. You got a high performance car specialist. All kinds of specialists. We're living a specialty world. When it comes to investing, the same thing happens. This is no longer 1980, where you could go to the bank and get a 12%, 15%, 18% CD and not have to worry about things. This is no longer 1980, where you could do your taxes yourself by longhand because they were simple. This is a specialized world that you need specialists to help you if you want to get to to get the most use and to be the best steward of what it is that you have. So that's what we're talking about on this show. This is not just where you can go to the bank the way your parents did and invest your money at the bank. No, you can't, because the banks are not safe. It's too hard to go from bank to bank to bank to bank to bank when you have to redo your CDs. So let a professional be able to help you shop for it and do it right electronically within their auspices. Make it simple for you. You've got other things that you need to do in life to enjoy your retirement. Educated retiree is a happy and stress-free retiree where you can go and you can enjoy the things that are most valuable: your children, your relationships. The money is just a tool to enhance your relationships. You've
Worry
been
about
listening.
what you want to spend your money on, what you want to spend your income on, instead of worrying about like how
There you
you're going to
go.
get it to.
There you go. Thank you, Daniel. That's a great way to put it. Now, we're closing up today's show. We want to give you this book, The Most Important Thing by Howard Marks. Call for your free copy to the next 5 callers at 800-725-7616. Remember, an educated retiree is a happy and stress-free retiree.